Greetings, this is Jeffrey Christian of CPM Group. I'm here in New York. I wish I could be in China with you, but circumstances prohibit it. I'm here today to talk about the findings in our 2021 Silver Yearbook. We partner with the Shanghai Huatong Silver Exchange in having translation produced and distributed in China. We've done this for many years now, and we're very happy with the relationship that we have with the Huatong Silver Exchange, and look forward to many more years of finding cooperation. We have a few new things this year. You will see at the bottom CPM Group and CPM Group China. I'll talk a little bit more about CPM Group China in a moment. But we are, in fact, moving forward to establishing an operation within China, and we are discussing not only providing research and consulting services with various Chinese entities, but also finding ways to work on a cooperative basis across a number of precious metals and commodity programs. I have a lot to cover today, and I'm going to try to go relatively fast. We have about a dozen sponsors around the world: mining companies, refiners, providers of precious metals research and consulting and investment products, wholesalers and retailers. We also have institutional investors, sell-side entities, groups across the spectrum of the silver industry. And then we have, as our partner, Huatong Silver Exchange. We also have started working with what we're calling media partners: Bullion, Bulletin in India, Glacier Publishing, which produces the Northern Miner in Canada, and a number of other companies. We've worked with Kitco for many years. We've worked with many of these companies, including Prospector News, for many years, but we're trying to get more formal in our operation. And then we're working with what we're calling distributors, which are companies that are not necessarily information distributors, but they're involved in the precious metals business, and they are saying to their clients, hey, this is some very good information and research on silver. And as I said, we have created CPM Group China. And we have Ku Shao in Beijing working for us at this point. He's working on our established relationships with Huatong Silver, China Gold Association, China National Gold Corp, but he's also reaching out to other companies and looking for ways to cooperate. We continue to speak with Kitco about managing a rejuvenated Kitco China, although those talks have gone slowly. And we're looking at how we can provide research, consulting services, advice, asset management services, across commodities within China, as we do around the world. There's a lot that's been happening in silver last year and in the first 6 months of this year. We've seen the silver price rise very sharply. It really started to rise in the middle of and second half of 2019. When the pandemic hit, the price fell along with everything else as the world entered a lockdown period, begun in China and then spread around the world in March. The price then started to rise sharply. In the middle of last year, it broke up above $20 and it moved up to about $32. And it's been trading basically between $23 and $30 ever since then. It's trading $28 as we speak. The world is in a bad shape, and it's not necessarily getting better. We've had a very steep recession in 2020 due to the pandemic and the subsequent lockdown. We're coming out of that. We still haven't fully recovered in that we're not back to where we were in terms of global GDP and national GDP in major economies in most parts of the world. We do think that 2021 and 2022 will see some recoveries, but we're concerned at CPM Group, and we're projecting another recession and another financial crisis, possibly as early as 2023, 2025. So the world remains extremely unsettled and uncertain. And that is one of the reasons why investors have stepped up their gold and their silver purchases and driven the price higher. Now, there's been a lot of misinformation spread around the silver market, and I'm going to go through a few pieces of data that refutes some of the false narratives that we're finding in the silver market. One of the things that you keep hearing is that the average grade of ore mined by silver mining companies, primary silver mining companies, has been falling, and that reflects the reality that the world is running out of mineable silver. Actually, the grade has been falling, but it does not reflect that the world is running out of silver. What it reflects is that the price of silver has risen. When the price of silver was lower in 2003, it was $4.90. In 2005, it was $7.26 an ounce. When the price of silver was low, silver mining companies had to mine a higher grade in order to try to stay in business. And even then, they were not particularly profitable. So you can see in 2005, $7.26 an ounce, 13 ounces per ton of grade was the average grade at 7 primary silver mining companies. And the average value per metric ton of ore was $94 for the silver content. By 2020, the silver price had risen 185% to $20.67 on average. The grade had fallen to 5.8 ounces per ton, not because the mining companies were running out of high grade ore, but because the price of silver had risen. At $20 an ounce, they could mine an average 5.8 ounces per ton ore, and they could be profitable. 27% higher revenue at a lower grade that was less than half of what it had been in 2005. So yes, the grade has been declining, but no, that doesn't reflect a world running out of ore. What it reflects is the higher silver price. And that's very important because we have seen for 40 years or longer, actually going back 50 years, we've had a constant drumbeat of people saying that the world's running out of silver and gold and copper and oil. And in all of those commodities and in other commodities, they've been wrong. In the 1970s, they were saying that by 1980, we would be out of copper and oil and gold. In 1981, there was a book that said that we were running out of silver, and by 1985, we wouldn't have any silver left to mine, and the silver price would rise to $100. And that $100 is important because ever since 1981, we continually hear that something's going to go wrong and the price of silver is going to $100. There's no magic in $100, but the marketing people who hype silver and try to convince investors to buy silver for wrong reasons. There are good reasons to buy silver, but they've tried to convince investors to buy silver for the wrong reasons. They keep coming back to $100 silver. And for 40 years, they've been saying the silver price is about to go to $100. And for 40 years, they've been wrong. And yet people believe them. Now, if you look at this data, and this data is in the Silver Yearbook, it's very complicated data. But if you go back to 1988, there were 7.8 billion ounces of silver reserves that were known in the ground. And we were producing close to 1 billion ounces of silver a year. If you come back up to 2020, we now have 16 billion ounces of silver reserves in the ground. So silver reserves have risen very sharply, 4.2% per annum over the last 15 years alone. And they are more than double what they were in 1988. Even though, if you look at on the right-hand side, from 1988 to 2020, we mined 19 billion ounces of silver. So in 1988, we had 8 billion ounces of silver reserves. In the subsequent 32 years, we've mined 19 billion ounces, more than twice as much. And at the end of that, we have more than twice as much in reserves still to mine. So what happens is, as technology improves, as parts of the world open up to mining, and as the price rises, resources, which are subeconomic deposits, become reserves. And we have seen this across commodities. The world hasn't run out of oil. The world hasn't run out of copper, and it hasn't run out of gold and silver. So when you hear people say that, stop listening. The world also hasn't run out of refined bullion inventories above ground. These are our estimates, and you can see the vast majority of it is implied, unreported, secret stocks held by investors around the world. And it's always been that way. And in fact, it used to be even more so. If you look from 1970 until 2007, when exchange traded products started to be developed for silver, you could see that much more of the silver estimated to exist in bullion inventories was in unreported inventories. That came down partly because the world was using more silver than it was producing from 1990 to 2005. And you saw investors selling that metal into the market. And you had about a 1.5 billion ounces of silver sold by investors and used by fabricators over that 15-year period. Then going forward, you started seeing people sell their unreported inventories and buying ETFs because they'd rather hold ETFs than unreported 1,000 ounce bars or small units. So we've seen an increase in reported inventories, but we've also seen that we still have perhaps 3 billion ounces of unreported inventories. And this is just bullion bars. There's another 2 billion ounces in silver coins that are not reflected here. Now, you say 5.5 billion ounces, that's a lot of silver. Where did it come from? Well, it came from cumulative production over the years. And in the Silver Yearbook, there is a table, a chart that shows 57 billion ounces of silver mine production over the course of history, most of it since 1850. So in the last 170 years, we've seen about 50 billion ounces of silver mined. A lot of that was bought by the US Treasury up until the early 1940s. And the US Treasury alone had about 3.3 billion ounces of silver at the onset of World War II. It lent silver through what they called the Lend-Lease Act to a number of countries and governments in order to help them finance their war effort against the Axis. And then over the course of the 50s and into the 60s, they sold off most of their reserves. So they have very little left in Treasury stocks, about 32 million ounces. London Vault holdings were never reported until July of 2016. They have been reported since July of 2016, and you can see they rose and they've risen sharply. They reached a peak of about 1.15, 1.18 billion ounces at the end of 2019, beginning of 2020. They came down in the first half of the year, but then they started rising again. And they're rising back to about 1.14, 1.15 billion ounces. And a lot of that, approximately 40% of it, is held in unallocated metal that's not held for ETFs. In New York, it's a similar situation. We've had a very sharp increase in silver inventories over the last really 4 years in New York. It got very high in early 2020 when there was an arbitrage opportunity to ship metal from London and other places to New York. And this increase that you see in early 2020 actually is a mirror to the decrease that you saw in London. Since that time, we've seen about 40 million ounces of silver come out of New York depositories. And again, the silver promoters keep saying, oh, well, we're draining all of the inventories. No, they're not. There are 353 million ounces of silver in 1,000 ounce bars. Forget the 100 ounce bars and coins. 353 million ounces of 1,000 ounce bars in the New York depositories as of the end of May. That is higher than at any point since September of last year. It's higher than it was a year ago. And you can see here, it's much, much higher than the 100 to 150, 160 million ounces that we had for most of the period from 2003 through 2017. So the world's not running out of silver. We have plenty to be mined, and we also have a lot in bullion form around the world. New York and London are reporting their stocks. New York has been reporting their stocks since the 70s, London since 2016. Switzerland, other countries don't necessarily report the their inventories, or we haven't started collecting it in a systematic fashion. But we know that there are very high inventories of bullion and coins around the world. Our yearbook has a lot of history there, and the history is based on the fact that we have been around for a long time. CPM Group is 35 years old now this year. We've been producing silver yearbooks and surveys since we left Goldman Sachs in 1986. Prior to that, we were at J. Aron and Goldman Sachs, and we produced those books. And then you see these little books on the side. Those are Handy and Harman books. Handy and Harman used to publish little pamphlets every year from early in the 20th century until 1993. After we left Goldman Sachs in 1986 and set up as an independent company, and a few years passed and it was clear that we were going to survive, if not thrive, as an independent research company, Handy and Harman stopped publishing its reports. And there is a brief history of silver research in the Silver Yearbook. Turning to investment demand, this is the driver for the price. And you can see here in 2017, 2018, we had about 55, 60 million ounces of net investment demand. In 2019, it fell to less than 40 million ounces of investment demand. In 2020, it was 80 million ounces. Investment demand more than doubled in 2020 compared to 2019. Almost doubled from the last 3 years. And there are a couple important things to see. And you can see here, we actually have our estimates are, our projections are that investment demand may continue to rise and exceed 100 million ounces this year. But there's something very important to understand when you're looking at the dislocations in the silver market that's apparent here. The silver industry, the refineries that produce medallions and small bars, and the mints, the national mints that produce official silver coins, gear their production to demand. And you could see from 2008 to 2013, very strong demand, 150, 140, 150, 200 million ounces of demand for silver from investors per year. And those mints and refineries geared up to meet that. And then demand fell off the cliff, and it was very low for 3 years. And they laid off staff and they closed down units, and they geared their refining and production of investment products to a much lower demand. And when demand came roaring back and doubled last year, those refineries and mints were not in a position to quickly double their production. The problems were compounded by the fact that with the pandemic, some of those refineries were closed for a while, and some of the mints were closed for a while. And when they reopened, they were coming back at 1/3 of their capacity to try to protect their staff from catching the COVID-19. So you had constraints on the production of small bars and coins. And some of those constraints continue today for logistical reasons. And that was one of the reasons why it was difficult to find coins and bars, and it was, and the price of silver rose. There's plenty of 1,000-ounce bars out there, but the investors wanted coins and smaller bars, and those things were harder to come by. I'll show you some premiums on that in a second. Silver typically outperforms gold in the late stages of a bull market for gold and silver prices. In the early stages, gold outperforms silver. but if you look at it, silver plays catch up and tends to outperform overall. And in all but 1 year, that has been the case in periods of time when gold and silver prices have been rising. That said, a lot of silver's progress relative to gold prices is in the market now already. And so increases in silver prices relative to gold prices going forward probably will be a little bit less dynamic than they have been over the last year. Silver coinage, as I said, rose very sharply after 3 low years. It rose very sharply last year. Our expectation is it rises further. The U.S. Mint has struggled to meet production, and they're off. They did rise to the occasion last year, but they are having blank delivery problems. And these are the premium. You can see the premium for a 100-ounce bar was very low, about 3%. And then last year, it shot up to 20-25%. 1-ounce silver eagle coins produced by the U.S. Mint, they were running around 12 to 15% premium, and they shot up to 40%, and they still are very high. And the 1,000-ounce bars was around 1%, 1.5%, shot up to 2.5%, came back down, and it's about 2.25%. And that obviously reflects the fact that 1,000-ounce bars are the good delivery bars that the price is set off of. So that is the comparison there. We also saw a tremendous increase in silver held by ETFs, primarily the SLV. Not all of that was investment demand, however. In London, you had some banks that were pulling back from trading gold and silver. They had record amounts of gold and silver in their inventories. I showed you the silver inventories earlier. And they sold some of those gold and silver inventories for ETF stock shares. And then they transferred those shares out of the bullion department into the equity trading department. So part of the 330 million ounce increase in ETF holdings that we saw last year wasn't investment demand. It was bullion banks actually using the SLV to reduce their exposure to silver. Fabrication demand declined. It declined about 5 or 6% last year. Our expectation, and it declined across the board. Just about every major sector except ethylene oxide and some other smaller uses declined. So you had silver use in solar photovoltaic panels down, electronics, auto electronics, jewelry and silverware, and of course photography continues to decline as it has for the last 20 years. We're looking at a very small increase this year. We think that the demand for some of these products will be slow to recover in 2021 and pick up speed a little bit more in 2022. I mentioned electronics. We saw a decline last year. It wasn't as deep as some people thought because there was an increased demand for home electronics as people shifted to working in their homes and they were buying more cell phones and laptop computers and other electronic devices. Demand for the auto sector, we saw a big decline last year because people were buying fewer cars. We are looking at a weak rebound this year. And solar panels declined, perhaps less than some people thought, and we see a rebound this year. Ethylene oxide catalysts were one of the bigger things, and you can see there's replacement demand for catalysts in existing ethylene oxide plants, and then there's new demand as new plants come on stream. And last year we saw some new plants coming on stream, even in the face of the lockdown. And so you saw a big surge in demand for silver for ethylene oxide catalysts for new factories. That will be less dramatic this year. So we're expecting lower demand for silver from ethylene oxide catalysts. Looking at supply, Supply fell about 1.5% last year. People are surprised because they know that mine production fell, and mine production did in fact fall more sharply. Mine production fell about 4.5%, but you saw an increase in secondary recovery from old jewelry and silverware. The increase in scrap was less than had been anticipated because government stepped up with financial support programs for individuals. So unlike in 2008, 2009, people didn't have to sell their gold and silver jewelry and decorative items and statues to raise cash to live. They were being provided cash support programs by their governments. So you did see some of that, but it was much more muted than it has been in past financial crises because the government stepped in to support their people. New mine capacity, new mines coming on stream have been dwindling, reflecting the lower silver prices since 2013. They've gotten very low over the last couple of years, and it's going to be very small this year. Some of our, one of our sponsors this year is Los Gatos Silver Mine in Mexico. It's a company that is part of the Electrum group of companies, major shareholder in it, Tom Kaplan, as a mining entrepreneur that we've been blessed to know for the last 28 years. And they have come on into production in 2019. They were running at full production last year, and they were one of the things that kept mine production from falling more sharply on a global basis. They were probably the only major mine that was expanding production last year, and that was because they were new. But you are probably bottoming out now in terms of new capacity coming on stream. And with the higher prices over the last 15 months or so, our expectation is that you'll start seeing new mines and expansions coming on. Producer costs rose sharply last year, partly because of the pandemic and the lockdown. And also these are per unit, and with lower production, more of the costs go into fewer ounces. And so you saw a price increase. But the margin is still very large, and in fact increased sharply because the silver price rose much more sharply than costs did. That's it for this presentation. I do want to stop where I started, which is to say CPM Group China is now open for business. Q Show is there to work with you and to help you see what we can do for you in terms of providing you research, providing you consulting and advisory services, maybe helping you with asset management programs or commodity management programs, including hedging programs. His contact information is here. Thank you, and I hope you have a good day. I'm sorry that I'm not there for a actual conference, and someday soon I hope that we are back there.